Let's start with a simple question. Why do financial markets suddenly become extremely volatile whenever there is a war or geopolitical conflict? You may have noticed something interesting. Whenever tensions rise between major global powers, markets react almost instantly. Oil prices spike. Gold rallies. Stock markets become unstable. Currencies start moving aggressively. But why does this happen? And more importantly, how can traders understand these movements and potentially trade them? In this video, we're going to break down how geopolitical conflicts, specifically tensions between the United States and Iran, affect global markets. We will also look at how volatility and liquidity change during these events, and how traders can adapt their strategies to survive and even take advantage of these conditions. Why wars affect financial markets? Financial markets are driven by one major factor: uncertainty. Investors and institutions prefer stability. They want predictable environments where they can assess risk and plan their investments. But when a war begins or when geopolitical tensions rise, uncertainty increases dramatically. Nobody knows what might happen next. Supply chains could be disrupted. Energy prices could spike. Global trade could slow down. And governments might introduce sanctions or economic restrictions. Because of this uncertainty, investors quickly begin to adjust their positions. And when large institutions start repositioning their capital, markets begin to move very quickly. This is where volatility increases. The importance of the Middle East in global markets. The Middle East plays a critical role in the global economy, especially when it comes to energy. Iran sits in a very strategic location near one of the most important oil routes in the world, the Strait of Hormuz. This narrow waterway is responsible for transporting a significant portion of the world's oil supply. Why volatility explodes during war? Volatility simply means the speed and magnitude of price movement. During geopolitical conflicts, volatility increases for several reasons. First, there's a constant flow of new information. Breaking news, military updates, government statements, sanctions, diplomatic responses. Each piece of news can change how investors view the future. Markets react instantly to this information. Second, institutional traders and hedge funds begin rapidly adjusting their portfolios. They might sell risky assets. They might buy defensive assets. And because these institutions move massive amounts of capital, their decisions create strong price movements. Third, algorithmic trading systems react automatically to geopolitical headlines. These algorithms scan global news sources in real time and execute trades instantly. This can amplify market volatility even further. The flight to safety. Whenever fear enters the market, investors begin searching for safety. This is known as the flight to safety. During geopolitical crises, capital often flows into assets considered safer or more stable. One of the most common safe haven assets is gold. Gold has historically been used as a store of value during times of uncertainty. When investors fear instability in financial markets or currencies, they often move money into gold. Another safe haven asset is the US dollar. Despite being involved in global conflicts, the US dollar is still considered the world's primary reserve currency. During crises, global capital often flows into US Treasury bonds and the dollar. Other safe haven currencies include the Japanese yen and the Swiss franc. At the same time, riskier assets often experience outflows. Stock markets may fall. Cryptocurrencies may become unstable. Emerging market currencies may weaken. This shift in capital flow is one of the main drivers of market volatility during wars. Liquidity changes during geopolitical crises. Now, let's talk about liquidity. Liquidity refers to how easily assets can be bought or sold without significantly affecting their price. In stable market conditions, liquidity is usually strong. Buyers and sellers are active, and transactions happen smoothly. But during geopolitical crises, liquidity can become uneven. Some markets experience increased liquidity. Others experience decreased liquidity. For example, gold markets may see increased trading activity as investors rush into safe haven assets. On the other hand, smaller stocks or emerging market currencies might experience reduced liquidity. When liquidity decreases, price movements can become more extreme. Even relatively small trades can cause large price swings. This is why markets can become very unpredictable during geopolitical events. How oil becomes the center of attention. During conflicts involving Middle Eastern countries, oil becomes one of the most important markets to watch. Oil prices often react faster than many other assets. If traders believe that oil supply might be disrupted, prices can rise sharply. Higher oil prices can trigger a chain reaction across global markets. Stock markets may decline because companies face higher operating costs. Airline companies and transportation sectors may suffer due to rising fuel prices. At the same time, energy companies may benefit from higher oil prices. So traders often watch the oil market closely because it can provide important signals about the broader economic impact of the conflict. Currency market reactions. The foreign exchange market also reacts strongly to geopolitical conflicts. Currencies often move based on global risk sentiment. During times of uncertainty, traders tend to move capital into stronger and more stable currencies. The US dollar often strengthens during global crises. The Japanese yen and Swiss franc also tend to appreciate because they are considered relatively safe. Meanwhile, currencies associated with higher risk environments may weaken. These shifts can create significant opportunities for forex traders, but they also increase the importance of risk management. How traders can approach these markets. Trading during geopolitical crises requires a different mindset. Markets become more emotional. Price movements become more unpredictable, and news headlines can move markets quickly. The first thing traders must understand is that volatility can create both opportunity and risk. Large price movements mean larger potential profits, but they also mean larger potential losses. This is why risk management becomes even more important during these periods. Traders should consider reducing position sizes, using wider stop-loss levels, and avoiding excessive leverage. Because during extreme volatility, markets can move rapidly in either direction. Watching key markets. When geopolitical tensions rise, experienced traders often focus on a few key markets: gold, oil, the US dollar, and major stock indices. These markets often react first to global events. Gold reflects fear and uncertainty. Oil reflects supply risk and economic impact. The dollar reflects global capital flow. Stock indices reflect investor sentiment about economic stability. By watching these markets together, traders can better understand how global sentiment is shifting. Understanding market psychology. One of the most important things to remember is that markets do not just react to events. They react to expectations. Sometimes markets move before major events even happen. Traders begin pricing in future possibilities. For example, if traders expect tensions to escalate, markets may react before any official escalation occurs. This is why professional traders often focus on price behavior rather than trying to predict political outcomes. Price action reveals what the market believes about the future. Final thoughts. Geopolitical conflicts like tensions between the United States and Iran have powerful effects on global financial markets. They increase uncertainty. They trigger shifts in capital flows. They cause volatility to rise. And they change liquidity conditions across different asset classes. Understanding these dynamics helps traders avoid emotional decision-making. Instead of reacting to headlines, traders can observe how capital flows between assets. They can watch how volatility expands. And they can focus on markets where institutional money is moving. Because in the end, markets are not just driven by news. They are driven by money moving from one place to another. And traders who learn to follow that flow have a much better chance of navigating volatile market conditions. Stay disciplined, manage your risk, and always remember, volatility is not the enemy of a trader. If understood properly, it can be one of the greatest opportunities in the market.